Sorry I'm a little bit late. I also tried to make sure the connection was as good as possible by restarting the network here, just to sort of get a fresh connection. You know, sometimes you have to restart your modem and so on and so on. And when I restarted it, it took a long time to reconnect for some reason. So yeah, sorry about that. But we're going to get started in just a minute. Okay, let's go. So a bit to talk about tonight. Interesting stuff in terms of psychology, risk management, and the way they sort of fix together. We started this Lessons from the Master series a little while back, and we've had a couple of presentations. This is part 2 of the sort of official one. We did a little sub-series that talked about the turtles and so on with a guest presenter, but this is sort of the official part 2, I guess you would say. And to give you all a bit of a reason behind the way we, the reason we wanted to do it in the first place, is that we're operating in this industry that is just full of big talk and big promises, and not just that, but also all kinds of differing opinions. As I was saying to one of our good clients earlier today, for every bear there's a bull, and for every bull there's a bear, and there's always a lot of different perspectives flying around the industry, and different ways of tackling different problems, and so on and so on. So the reason we wanted to do this is to give you perspectives from, not necessarily us, but perspectives and lessons and so forth that we've learned from the people that really have somewhat, I guess, as close as possible to impeccable reputations in the industry, the people that have gone out there and done these things for many, many years and have been incredibly successful at it. And in the case of Mark Douglas and Van Tharp that you see there, Van Tharp and Mark Douglas, that is, from left to right, and they've also been extremely influential. So they've put out a lot of books and a lot of video content and so forth. Rest in peace, Mark Douglas. Unfortunately, he passed away a couple of years ago, I think it was. But nonetheless, the whole idea behind these Lessons from the Master series is to, as it says there, talk about some time-tested, real-world applicable principles that have really just been learned the hard way from the industry's true Hall of Famers. And so that's what we want to do. Now, everyone talks about psychology and everyone talks about risk management. Everyone will tell you that they're important, and they are incredibly important. But what we really want to emphasize in this presentation is an aspect of it that is sort of somewhat not talked about that much, and that's the fact that they're heavily related. They're heavily interrelated and interdependent, in the sense that if you know your numbers, and if you have a concept of the way the statistical averages work, and concepts of random distribution, and quantifying your risk, and quantifying your risk is just a fancy way of saying know what it is you're risking, then if you're able to do this, the psychological side of things actually very, very largely takes care of itself, and that's due to the way the human brain works, and we'll talk about that a little bit. So now, on the psychology side of things especially, it's an aspect that's almost completely overlooked by beginners. It's something that, yes, you're sometimes taught, but it's something that people tend to underemphasize the importance of, because you don't know the bad habits and the biases that you have necessarily. You're not very consciously aware of them unless you start to see them, their effects and the way they actually manifest themselves in habits. And trading is a very good way of doing that, because you can directly see how your biases and emotional habits of thinking are affecting your trades, your missed trades, your early exited trades, and your bad trades that you held on for too long, and that trade that you got too excited about, that you risked too much on, so on and so on and so on. So they say in the trading business that you learn a lot about yourself as you go through, and it's absolutely true. Nonetheless, and it's tough to emphasize because no one really wants to admit it, believe it or not, but the psychological aspect is incredibly important, and it's something that's almost completely overlooked by beginners, but the more experienced in the industry, in the business, will tell you that actually everything depends on psychology. So not just in the sense of the markets themselves when they go up too fast because people are greedy, and when they go down too quickly because people are too fearful, but in terms of your own decision-making process. So psychology, if you've ever read a psychology book or studied it, or maybe you've even been to a psychologist, who knows, you know that it's a very, very deep and involved kind of topic, and so we won't be getting you on the psychiatrist's couch today, but the reason why psychology is so incredibly important is that it has an effect upon literally everything you do, because trading and investing is all about making well thought out, calculated, evidence-based decisions and following that decision-making process. Now, if your psychological state isn't conducive to that, isn't helpful to that kind of process, then everything's going to be affected. And it's not something that's exclusive to trading, of course. You've got the best athletes in the world that have motivators and psychology coaches and so on and so on and so on. For example, you can be the best racing car driver in the history of the sport, in the history of the pursuit, but if for whatever psychological reason you're not able to focus on braking at the right time and turning at the right time and limiting your speed and being in tune with the vehicle that you're driving, it doesn't matter how good you are. If you get out there and you make a few stupid emotional decisions, well, bad things are going to happen and you're not going to be the greatest for very long. So at the end of the day, psychology, in the trading sense and other senses, really all comes down to one thing. It comes down to avoiding self-deception. Now, we don't realize how much we do this because we're humans, and we all think that we're logical. We all think that we're doing things in a clear-headed manner, but the harsh reality of it is that we're not, and even the best of us are not doing it all the time. We're all still victim to this phenomenon of self-deception. Okay, so now the way to get over this is to try to quantify things and to take a logical and objective rather than subjective approach, an evidence-based approach, that is, instead of an emotion-based approach. Some people call it the bottom-up method versus the top-down method, and that's more of a scientific term than the strictly an investing one. So now, we spoke last night about the difference between gambling and trading, and it's a really interesting phenomenon. I actually get disappointed when I hear people that have been in the industry for a while talk, not really understand the difference, or try to say that there's really no effective difference between gambling and trading/investing. Well, there absolutely is. It's not a debate if you actually understand the definitions of the terms. So gambling by definition is to play games of chance for money or to bet. Emphasis on play and emphasis on games. And 2 is to take risky action in the hope of a desired result. Now, emphasis upon hope and emphasis upon desired. Now, investing by definition is to put money into financial schemes, shares, property, or a commercial venture with the expectation of achieving the profit. Okay, so it's a very different pursuit, and it's a very different dictionary definition from going into something with a hope and a desire as opposed to an expectation of achieving a profit. Okay, so any self-respecting investor/trader has no room in his vocabulary, in his approach, for words like hope and desire. Well, maybe, but desire cannot affect your decision making because it's actually has no direct relation to a realistic expectation of achieving a profit. So these lessons from the Master Series are a little bit more advanced than some of the other ones we've done. We did another one in the series, in the Let's Teach the Newbies series, where we talked about the difference between trading and gambling. But to really sort of sum it up, you would ask yourself the question of whether or not the owner of a casino is a gambler. Well, if not, why not? He's around gambling all day long. His profit and loss is based upon games of chance, but no one in their right mind is, with any kind of real definition, understanding of the definition of the word, is going to call a casino owner a gambler in the same way that his clients, his patrons, are gamblers. Gamblers is just not the same thing. So we're going to explore that in a little bit more detail tonight. So, Vern Tharp, he's still around, by the way. He doesn't look that young anymore. But he's still around, running workshops and doing other things. He's got some great books out there, by the way, if you want to delve a little bit further into it. And some other sort of good videos around the place too. So we're going to talk about some of these principles and just sort of put it in their words, the words of the masters, so to speak. So here it is. The real purpose of trading is not to make money. If that's your goal, you'll probably struggle. But all of the following tend to work. If your goal is to be a great trader, then you'll probably do well. If your goal is to use trading as a way to measure your self-development, then you'll probably do well. If you just love trading and that's why you want to do it, then as long as you're willing to work on yourself, you will probably do well. Those, in my experience, are the key motivations that bring success in trading. Now, why is that? Because it's about achieving the goal of being being better at what it is you're trying to do, and rather than letting the emotional influence of money skew your judgment and skew your thinking and essentially dilute your motivations, or skew your motivations is the best way of saying it. Next one. So there is a strong psychological bias to be right about what we do with our investment. In most people, this bias greatly overrides the desire to make a profit or inhibits us from reaching our true profit potential. So most people have overwhelming needs to control the market. As a result, they end up with the market controlling them. So this pertains to the idea of, it actually talks about statistical averages and statistical distribution, and the fact that you shouldn't be emotionally involved with any one particular trade at all. In fact, if you have a profitable system, even if you have a very profitable system, even if you have a very high accuracy rate, it's never going to be 100%. So even if you're one of the best ever, and let's say you have a 90% strike rate, or win rate, which is very unrealistic, then you've still got to accept that just by pure chance, pure statistical probability, at least 1 in 10 of your trades are going to be wrong. And why would you get emotional about that whatsoever when you just accept it as part of the statistical process? And if you don't do that, you're going to end up in a situation where you're essentially at the mercy of the market. It's whims, it's follies, it's random patches of being more irrational than other times is going to essentially control your life and affect your mood and have far too much of an influence upon your decision-making processes therefrom. All right, now, next one here. So when you understand what's involved in winning, as professional gamblers do, you'll tend to bet more during a winning streak and less during a losing streak. However, the average person does the exact opposite. He or she bets more after a series of losses and less after a series of wins. And it's just one of these very counterintuitive things that we do, that we engage in. It's amazing how many of these things are highlighted to you when you start placing a few trades and analysing what you've done and what you haven't done and what's worked well and what hasn't done well. But what's maybe surprising to some is the mention there of professional gamblers. Well, how do you be a professional gambler? Well, you have to, number one, you have to choose the games that there is an actual possibility of winning in. So, for example, you might talk about counting cards in blackjack, or if you're playing poker, of course, poker is a gambling game. It's a gambler's pursuit. It's a gamble by the accepted definition of the word. Yet, very, very consistently, you get the best poker players. You see them on TV and so on, that will consistently win the big pots, consistently be able to build and develop a career out of it, because they're playing the other person, they're understanding their own psychology, they understand the statistical averages, and they have a strategy that they can put forth and employ, that is. And so that's what qualifies them to call themselves professional gamblers, even though it may sound like a counterintuitive term. I don't gamble, by the way. I've never liked it. I've actually gambled, I think, once or maybe twice in my life, besides the odd pool, the odd office pool for the Melbourne Cup and stuff like that. But yeah, just in case you think I'm a chronic gambler or something. So every act in life has both positive and negative consequences, profits and losses, so to speak. So the best we can do is accept both while leaning towards the light. In other words, nothing is going to be perfect and nothing is going to be completely predictable. You do have to be able to predict the market to some degree of accuracy in this game relative to your average profit and your average loss. But you have to always accept the fact that you can never predict it completely, and simply do your best to lean in toward the favourable probabilities. So we're in the probabilities game here. We're not in the certainties or the absolutes game. All right. So that's Van Tharp, and this is Mark Douglas. Rest in peace. So, along a very similar vein, to be a successful trader, you need to trade without fear. when you use fear as a resource to limit yourself, you will create the very conditions you are trying to avoid. Or to say this in another way, you will experience your fears. So this is very, very true and very, very common. And again, it's another thing that people don't really realize that they're doing until they've been doing it for so long that they've got no choice but to sit down and analyze why they're not getting the results they're after, or they're losing too much money, or risking too much money, or continually repeating bad habits. Well, it's because they're just constantly repeating the mistake of letting emotion, and in this case fear, come into their decision-making process. And in terms of the way fears manifest themselves, well, you can think of a lot of examples of that in life, in terms of fear of failure. If you're too shy or too nervous going into a job interview, for example, and you're worried that you're underqualified, or you're not able to do the job properly. Well, if you're too nervous in the job interview, for example, then you're probably not going to get the job, and because you're nervous, even if you do have the skills. In other words, you're basically manifesting your fears. So there's when I was learning to ride a motorbike, there's another thing they teach you in terms of the safety side of things, is this idea of they call it hazard fixation. And basically what that means is that your motorbike will tend to go in the direction in which you're facing, and toward that which you're focused upon. And so what happens a lot of time is when, let's say, a truck or a bus comes out of nowhere, your whole, not just your head and your body and your perspective will turn towards the bus, the hazard, but so will your mental focus, and it actually hinders your ability to effectively avoid the hazard, and will actually is more likely to steer you towards it and get hit by the thing that you're scared of. That's just one of these kind of ironies that in terms of the way we work as human beings, our minds. So, what you need to be able to do is you need to learn to accept the loss without guilt, anger, shame, or self-punishment. It's just part of the process. If you're taking a business approach to trading and investing, and if you have enough confidence in the profitability of your system, then you will also have an understanding that, again, your system is not going to be perfect. Your strategy is not going to be perfect. It is going to pick ones that simply don't turn out the way you'd expect that they probably would. And you need to learn to think of this as not as a loss or any kind of failure. As long as you've stuck to your strategy and stuck to your process, then you can train yourself mentally to just see this as a cost of doing business. Okay, so it's not a loss, it's just a cost of doing business. Obviously, we want to minimize our costs and maximize our profits and have as few costs as possible and as many winners as possible. But in business, like anything else, you can never get away from having some costs. And in the trading investment business, then, if you're predicting something with 90% accuracy, that means you've still got a 10% so-called failure rate. But it's not a failure; it's just part of your statistical probabilities not working out in that particular occasion. And so you just see it as a cost of doing business, and it's not something to worry about. So entering a trade will involve all your beliefs about opportunity in relation to risk, missing out, needing a sure thing, and not being wrong. Exiting a trade will involve all your beliefs about loss, greed, failure, and control. Considering the unlimited potential for profits, entering the market will be much easier because exiting will require you to confront your beliefs about greed, loss, and failure in relationship to the constant temptation of the possibility for unlimited profits. So there's this very common phenomena in traders, and especially the newbies, of course. They have a tendency to get rid of their winners far too soon and to hold on to their losers for far too long. I've lost count of the number of times I've spoken to a client who was, considering investing in our services or another service or whatever it is, but they were stuck, according to their perspective, stuck in an investment that they'd already lost 30, 40, 50, 60% in. And they would say that they didn't want to leave that investment because it would then crystallize their losses, as they put it, or that would lock in their losses, so to speak. And so what they end up doing is they hold on to a bad investment with some kind of hope or some kind of really just a desire more than anything that the thing is going to come back, and when it comes to break even, that they're going to get out and try to get out of it unscathed. But the reason it's down is because it was, even though you didn't realize it at the time, it was always more likely to go down than up anyway. And so you've got to ask yourself what the likelihood of it coming back up really is, and what you're missing out on in terms of other opportunities, and thereby ignoring the fact that your trading and investment lifetime, career, whatever you want to call it, is made up of a string of trading and investment decisions. So just like holding on to a particular trade or particular company, particular currency or commodity or whatever it is for too long, it doesn't matter. You've just got to accept the fact that whatever method of analysis or method of decision making that you employed in order to get into the thing, it didn't work out this time, and so you cut your losses and you move on to better opportunities if you can. Okay. And again, if you understand your win-loss ratios and your something called your statistical edge, your profit factor, expectancy, other things that we'll talk about, then again, you don't have any emotional investment in any particular investment whatsoever. So the question is, why don't we do these things? One of the things, we started running more coaching sessions and so forth, and trying to get people to approach the markets in a business-like manner. And this psychological aspect, this emotional management aspect of it, is very often something that you can, that when I'm trying to explain it to people, you can hear them and you can sense them thinking, this is, I don't need to hear about this. I'm fine. I've got my emotions under control. Well, if you think that, then you're much more likely to be one of the people that's going to suffer from biased decision making and emotion-based decision making as it is. Because once again, sorry about that. I think we lost connection for a second. So in case you missed out on that, we're basically talking about the fact that people don't want to ask themselves the hard questions and take a good hard look at themselves, and we make all kinds of excuses for this. We don't want to learn how to do things in a better way because we consider ourselves being too busy or whatever the case may be. Well, if you're going to get into this trading and investment business, then you've got to be able to do that. You've got to be able to constantly look to refine and improve things, if you have a basic understanding of the concept of compounding interest, then you'll know that small things can and do make a very big difference over time. But you've got to be able to know why you're doing particular things, measure the success of them, and be willing to analyze them and be willing to refine and improve them if they're not working out so crash hot. So why don't we do this? Well, it's because human beings are actually really good at lying to themselves, really good at that thing that we talked about earlier on, that phenomena of self-deception. And why don't we realize this? Why don't we know that we're doing it? Well, the reason is because we're good at it. If you're trying to deceive someone, the person you can deceive is the person that you understand the most, because you understand what their desires are, you understand their thinking processes, you understand the way to press their emotional buttons to try to get them to think the way that you want. And you've got to remember that you do this with yourself. You negotiate things with yourself, and you are very good at deceiving yourself because nobody knows you better than yourself. Okay? So that's why it happens, and the reason why we don't realize it is because, well, like any lie or like any form of deception, you never realize that the deception is a deception if the deception is successful. As long as you believe it to be the truth, it's, as far as you're concerned, it's the truth, and you're never going to realize that you're actually deceiving yourself. So there's in trading, there's a very strong phenomena, very common phenomena of it's called cognitive dissonance, and it leads to something called confirmation bias. Cognitive dissonance essentially is the tendency that we have as human beings to reject harsh realities and to instead choose what we want. So we tend to choose things on an emotional basis rather than a objectively factual and truthful and logical basis. Now, we don't realize we're doing it because the emotional side of our brain is actually reacting first. It reacts before the logical side of our brain thinks about these things. So we actually think that we're making logical decisions. Most people think we're making purely logical decisions, but in actual fact, what you're doing is you're making at least partly subconscious emotional decision, and then you're justifying it later on with the version of logic that best suits what you've already decided that you wanted on an emotional basis. Yeah, that's just the way we work, and it works. You can see it manifested in, of course, relationships and politics, of course, and absolutely in business decisions, and of course in trading and investment, and basically every aspect of human society. Now, just in case you think that you're beyond this thing called self-deception, well, let me show you how wrong you are. We've all seen various optical illusions around the place. There's a million of them on the web. If you want a really interesting one, I found one the other day. It's actually an audio one. If you Google brainstorm green needle, you'll see what I mean. It's really quite incredible. But this optical illusion that you see on the screen there is just a very, very simple one. It's parallel lines. The lines that you see there are perfectly parallel, but when you see them at a glance, unless you're really measuring things, then you're going to perceive them as bent lines or skewed lines, or not parallel, basically. So there's 1,000,001 different examples of these types of optical illusions. What's really amazing about optical illusions, however, is that you can get a ruler and you can go and measure that on screen right now, and you can effectively prove to yourself that those are those are parallel lines. And then you can walk away and you can come back 10 seconds later without the ruler, and you're still not going to think that they're parallel lines. You're still going to be effectively deceiving yourself from the way that it just appears at the outset. So it's a very, very powerful thing in trading and of course other areas of life and society. So now how does all this business, psychology and emotions and all that, how does it all relate to the markets? Well, in a number of different ways. Let's take an example here. So we're looking at gold here. I'm going to bring this up. So trading and investing, for example, there's this phenomenon known as painting the charts, or painting your own reality. And again, it comes down to this idea that you're coming into something with something that you want, a predisposition, and you're then simply going to look for evidence that supports what it is you already have decided that you want to believe. So, you can take a really simple example of this. If we look at something like okay, so we can draw a few trend lines like that. We can throw on a few indicators like Fibonacci and so on. And then we see that there's a Fibonacci extension down there. And so now when you ask most people which direction they think this market is heading in, they're going to say it looks like it's going down. It looks like it's bearish, right? Well, that's because you have these big thick lines there, big thick lines there, and you've got a downward sloping line there, and you've painted yourself a target that's below the current price. So you're basically just effectively creating your own reality here, right? There's a number of reasons why you might do this. You might have heard something on the news, or heard something that Warren Buffett said 20 years ago about gold, or whatever the case may be. You now think it's going down. Okay. Now, we're pretty zoomed in here. We're going back just April to October now. What if we zoom out a bit? What if we zoom out a bit further? Or what if we put this on a monthly chart, for example? Okay. Well, doesn't look as one-sided now. And what if we start drawing some different trend lines, like so? Right? We start placing some different coloured lines on things, like that. And you get the idea. I mean, you can do this all day long with as many lines as you want, and you're just basically painting your own reality. Okay, so you've just gone from something that you thought 5 minutes ago was really bearish and was going down, And now, maybe because you heard a different report, or you heard something Warren Buffett said 5 years ago instead of 10 years ago, and you come into the chart and look at it with a completely different perspective, a completely different desire, effectively. So getting back to this concept of confirmation bias, you basically just go out there looking for evidence, so to speak, of what it is that you really just want to believe anyway, that doesn't necessarily have any real grounding in objective reality. All right? So when we approach these things, again, it all comes down to taking this business approach. So you have to have, like all businesses, most businesses are still run by human beings. So there's areas in which judgment and discretion and instinct and experience comes into play. But just about any successful business still has policies, still has processes, and it still has guiding principles. And it definitely has things that you definitely can't do, that are totally against company policy, for example. So when you learn to trade, or you go through this trading process, you've basically got to follow that business aspect of things before you allow yourself any room for a discretionary, as they call it, or a judgment-based call, a judgment-based opinion, right? So some people have a purely systematic and a purely mechanical, effectively, way of going about finding trading opportunities, meaning that it's just basically a checklist type approach. For example, there's a moving average there. Okay, so part of your discretionary approach has to be in an uptrend. It has to be below the slow moving average, or the medium term moving average. It has to be. There's a whole range of different things. You can use MACD and Fibonacci and so on and so on. It must be close to a Fibonacci retracement level, or whatever it is. Let's just use that for the sake of example. Okay, so it has to be close to the 50% Fibonacci retracement level, as an example. And these discretionary traders will just go through this process, and there's effectively no room for human judgment, experience, discretion, opinion, or anything like that. It's just, is it this, and this, and not this? Great. Well, in that case, we're going to risk 1.5% of our trading account on that, and it's just blindly followed, so to speak. Others have more discretion, but myself included, and I do use my experience and just a bit of a sense of the market, but it's very much a rules-based discretionary approach. There's a process that I have to follow in order to get me to the point wherein I can then make a reliable discretion-based decision, or make a reliable judgment on the thing itself. Okay. Right. So that's the market analysis side of things, and the process that you go through. The other thing that you need to do is have an understanding of this concept of statistical distribution. So just a moment, I'm going to Just let me bring this up. Bear with me a moment, please. Just a sec, I'm just trying to find you the web page there. Here we go. So we actually talked about this in one of the beginner sessions that we did. I'm just going to sort of skim through it now. So again, coming back to this idea of randomness. And essentially learning to think like the owner of the casino rather than a client of the casino or a patron of the casino. It's just taking a bit to load here. Not sure why. Sorry, just a second. Okay. Okay now, so yeah, sorry about that. Now, what does this all mean anyway? What are you talking about, Adam? Well, I'm going to sort of skim through this because we talked about it in a previous session, one of the Let's Teach the Newbies session. But when you start, what we're doing here is we're rolling 3 dice. Okay, 1, 2, 3. And we're just rolling one at a time here. One combination at a time. And after you do this for a while, it seems like the results that you're getting here kind of seem like they're random. You know, there's 7, 10 combinations. There's only 1, 12 combinations. Only 2, 11 combinations. Well, why? Well, it's this thing called randomness. But we often don't see the pattern and the fact that things aren't actually random because we're too zoomed in and we're too focused upon a short time frame, a short data set, a small data set, as they say. So if we start adding 100 at a time, as we're doing here now, you can see things start to look different. Now if we go start adding 10,000 at a time, things look very different. So we're up to 330,000 rolls now. And what you can see, of course, is that this looks anything but random. Anything but. It's a very clear statistical pattern. Why is that? Well, because, quite simply, there's more potentials, there's more possibilities, more ways in which the number 9 total can be achieved with 3 dice, 3 threes, 1 5 and 2 2s, so on and so on. Same with 10, same with 11, but not so much with 3 and 4. There's only one possible combination to get 3s, a total of 3, that is, from 3 dice. Okay, so it's not random, it's just part of a statistical pattern. Now, where this works in trading is that if you have a strategy that you're following, then you should be able to have enough faith in your system that you don't get emotionally involved in any particular trade, and you don't let emotions come into your decision-making process whether or not to take any particular trade or investment. You're essentially following a process, and by following a process and having an idea of the average profit and the average loss and the probability of a loss versus a profit, then you are able to make a very clear-headed judgment as to whether or not that particular trade is worth taking risk on. Yeah? So that's what we're really doing at the end of the day, is we're getting out there and we're just trying to look for good risk. There's no such thing as no risk, but there is such thing as good risk. And a good risk is something that is going to cost you a small amount of your account if it goes wrong. It's going to make you a decent amount of profit if it goes right. And it has a relatively favorable probability of being profitable instead of unprofitable. So I hope that makes sense. So now we have a calculator on the website that I'll just sort of skim through pretty quickly. A lot of this stuff's going to be delved into later in some of the more in-depth and structured education sessions, but what you can do with this calculator is you can put in your account balance there, put in the amount that you're looking to risk per trade, let's say 1%. You look at your acceptable risk to reward ratio, and let's say we want at least 2 to 1. And then you look at the accuracy of your trades. Now let's say for the sake of this example, sorry about that. Let's say for the sake of this example, we're gonna, by the way, whenever you see these calculators on the website, just always edit the blue cells only. Don't worry about the other ones. And let's say, for example, we have an accuracy of, let's say 66%, 2/3, just to make it a little bit interesting. Okay. Well, that doesn't give us very good. Let's make it 50% actually to talk about another point. So now what that means is that, just to recap here, you've got an account of 10,000. You're willing to risk 1% on an acceptable trade. The average risk to reward is 2 to 1. So you're risking $2. Sorry, you're looking to make $2 for every $1 that you risk, and you get these trades right half the time, 50% of the trade. So you're targeting 2% per trade. You're looking to make $200 on the ones that work out well, lose $100 on the ones that don't go so well. This is the actual number of trades. This is actually a number of opportunities, that is. And so let's say you get per annum, so you get 50, we'll say 10 trades, for example, just for the sake of this example. So that means you're getting 5 winners, 5 losers. The expectancy ratio, as it's called there, is 0.5. The average return is $50. Now, what is that average return? Well, the average return there is the difference between your average loser and your average winner as a ratio of your accuracy rate, your strike rate. So in other words, 200 minus 100 equals 100. $100 left over divided by 50%. In this case is 50, as you see there. So now what that means, when you can actually do this, it means that every single one of your trades, as long as you're following the process, is worth $50 to you. Okay? So when you find a valid opportunity, you don't worry about whether that opportunity is a winner or a loser. All you need to worry about is whether or not it actually meets the definition of a valid opportunity. Because you know, based on the statistical averages, that every single valid opportunity is on average worth $50, whether or not it's a winner or a loser. Whether that particular one is in the winning 50% or the losing 50%, it doesn't matter. Because in this case, you're getting 2 times your average profit, your average loss. Okay? So this is the concept that you need to understand from a risk management perspective, so that the psychological side of things doesn't creep into your mind and doesn't affect your decision-making process. Every trade, every valid opportunity is worth a certain amount. Okay? Now, obviously, what you want to do is you want to be able to maximize that. You want to be able to maximize the average trade return. So let's say, for example, instead of getting it right 50% of the time, you can start getting it right 60% of the time. Now your average valid opportunity is worth $80 to you. Okay? And in this case, what that ends up with is a return of 8% per annum, or a total net return of $800, 8% on your 10,000. Pretty conservative, but the reason for this is that you've got a low number of opportunities. If you can get, let's say, 2 trades a week, 100 trades a year, then obviously things start to look a little bit more attractive there. Okay? Because you're just multiplying the average return by the number of valid opportunities that you can find. All right? So we mentioned in the email, you hear around the industry the secret of this and the secret of that, and the magic formula for predicting the future, and so on and so on and so on. They do not exist. Well, if it does exist, no one's brought it to my attention yet, and I've been in this business for some 15 years now, thereabouts. The real secret is actually knowing what this number is, knowing what your average return is. And so, because once you know that number, it's just a matter of getting out there and trying to find as many valid opportunities that meet that criteria as much as possible, as many as possible. Yeah? So, yeah, that's the way it works. That's about it for now. Hope you've survived thus far. Now, so if you want to learn more about this, we now are running these. We now have a VIP membership. It comes as a monthly subscription, or you can get a little bit cheaper if you want to pay your membership in advance. So it's pretty. We think it's higher value than most of the ones out there, and priced at about the same, and so cheaper than a lot of them anyway. But the mid-level membership, if you pay it in 12 months up front, works out to $1,080. Now, the thing is, you're going to need a broker to trade these signals and to apply these principles through anyway. So what we've done is we've gone and partnered up with the broker that we consider to be most suitable for these types of strategies and markets and ideas that we share with our clients. And they've been good enough to actually offer to pay our clients first 12 months membership, which is great for everyone because, helps you come on board, helps you join us as a client. You're going to need a broker anyway, so you might as well have a really good broker, and you might as well have a broker that's going to help you get started and get your full 12 months paid for. So it's a good deal. If you want to find out more about that, just go to IU.com.au/VIP. And if you're on the webpage, which I assume you are, you can also just scroll down. We've got a whole range of upcoming events, live market opportunities, short-term trading versus long-term investing, technicals versus fundamental analysis, risk and psychology, goals in constructing a trading/investment plan. And you'll find more if you just go ahead and scroll down the page there. You can contact us, you can chat to us, you can give us a call and have a bit more of a browse around the website if you want. But otherwise, that's iu.com.au/VIP to find out more about the offer and actually get started with the preferred broker, which is Saxo Capital Markets Australia. That is, they're all over the world. They've got a full European banking license, fully set up and obviously regulated under ASIC in Australia. Funds are secured through HSBC Australia. They give you access to 35,000 markets across the world, every asset type from physical shares to FX to futures to options to CFDs, direct market access, CFDs that is. So basically everything that you could ever want to trade, and almost certainly everything that would be coming through the Signals and Education membership process, membership service. So if you open up an account with them, once again, get everything set up and paid for free. But that's it. If you have any questions at all, reach out. Don't be shy. Other than that, we wish you successful trading and investing, and thanks for coming along. Bye for now.